All right, class. Let's dive into a real-world example to get our hands dirty with some accounting. Today, we're looking at a small business called B&B Repair Services Ltd. This is a repair company that's been around for a while, and it's our job to help them keep their books in order. Now, I want you to imagine that it's the last day of July, July 31st, 2018, to be exact. At this point in time, the business has recorded all its balances in the accounts. Here's the list of accounts and their amounts. Listen closely as I read them aloud and try to picture what each account represents. July 31st, 2018, account balances. Accounts payable, $2,300. Accounts receivable, $3,200. Accumulated depreciation on equipment, $2,000. Accumulated depreciation on vehicles, $5,000. Bank loan payable, non-current, $4,000. Cash, $8,040. Common shares, $14,000. Equipment, $10,000. Retained earnings, $17,290. Salaries payable, $1,420. Supplies, $1,030. Unearned revenue, $1,260. Vehicles, $25,000. These numbers give us a snapshot of where the business stands financially at the end of July. You can see we've got a mix of assets like cash, vehicles, and equipment, along with liabilities such as accounts payable, unearned revenue, and a bank loan payable. And of course, we also see equity items like retained earnings and common shares, which show the owner's investment and profits kept in the business. Now let's fast forward to August. B&B Repair Services had a busy month, and we're going to review everything that happened. I'll read through the transactions one by one, so pay close attention. Each event affects the business's financial position, and it'll be your job to figure out how to record it in the company's books. Let's go. August transactions. 1. On August 1st, the company paid $250 for advertising on Kijiji. This was for the current month's advertising expenses. 2. On August 2nd, they provided $1,260 worth of services to customers. Now, here's the key. These services had already been paid for in July as part of unearned revenue. That means we're recognizing the revenue this month. 3. On August 3rd, they paid $980 for the office rent for August. 4. On August 6th, the company received $1,200 in cash from customers. This was payment for amounts they owed from earlier transactions. 5. On August 7th, they signed a contract with Merithew's Appliances Ltd. To provide future repair services for its customers. Now, no money changed hands for this one. It's just an agreement for the future. 6. On August 10th, the company paid employees $3,120 in salaries. Let's break this down. $1,700 was for August salaries, and $1,420 was the amount they owed for July salaries. 7. On August 13th, they received $2,800 in cash for repair services they performed during August. 8. On August 15th, they purchased new equipment worth $2,000. Instead of paying cash, they financed the purchase with a bank loan. 9. On August 20th, they paid $2,000 to their creditors for amounts they owed on accounts payable. 10. On August 22nd, the company purchased $800 worth of supplies on account. That means they didn't pay cash right away. They'll owe this money in the future. 11. On August 24th, they paid employees again, this time $2,900 in salaries. 12. On August 27th, the company billed customers $3,760 for services they performed in August. Notice they haven't received the cash yet. It's just been invoiced. 13. On August 29th, they received $780 in cash from a customer for services they'll perform in the future. This is unearned revenue because the work hasn't been done yet. 14. On August 30th, they made a payment of $500 on the bank loan and also paid $50 in interest. 15. Finally, on August 31st, they paid $380 in income taxes. On the same day, they declared and paid $400 in dividends to their shareholders. That's quite the list, isn't it? But don't worry, we're going to take this step by step. Here's what we're going to do. 1. First, we'll journalize each transaction. That means we'll record them in the general journal using the proper format, debits and credits. 2. Then, we'll post those entries to the general ledger. This involves updating the account balances based on the opening balances we saw from July 31st. As we work through this, I'll guide you to think about the key questions. What accounts are affected? Are they increasing or decreasing? And is it a debit or a credit? By the end of this exercise, you'll have a much clearer understanding of how we keep track of a business's financial activities. Are you ready to get started? Any questions before we dive in? All right, everyone. Let's walk through the transactions for the first 10 days of August. Remember, we're going to apply our 3-step process. 1. Step 1. What happened? Identify the transaction. 2. Step 2. Which accounts are affected? Determine what accounts are involved and whether they increase or decrease. 3. Step 3. How do we record it in the journal? We'll decide which accounts are debited, which are credited, and include the amounts. Let's get started. August 1st, paying for advertising. Step 1. What happened? The company paid $250 for advertising on Kijiji to promote their services for the month of August. Step 2. Which accounts are affected? Advertising expense increases because the business is incurring this cost. Cash decreases because the company paid this amount. Step 3. How do we record it? To record this, we debit advertising expense for $250 to show the increase in expenses. Credit cash for $250 to reflect the decrease in money. The narrative for this entry is paid for advertisement expense. August 2nd, recognizing revenue from unearned revenue. Step 1. What happened? The company performed $1,260 worth of repair services for customers who had already paid in July. This amount was initially recorded as unearned revenue because the service wasn't performed at that time. Step 2. Which accounts are affected? Unearned revenue decreases because the company has fulfilled its obligation. Service revenue increases because the company has now earned this income. Step 3. How do we record it? To record this, we debit unearned revenue for $1,260 to show the decrease in this liability. Credit service revenue for $1,260 to record the income earned. The narrative for this entry is earned revenue from services previously paid in advance. August 3rd, paying rent. Step 1. What happened? The company paid $980 for rent for the month of August. Step 2. Which accounts are affected? Rent expense increases because rent is a recurring cost of operating the business. Cash decreases because the company paid this amount. Step 3. How do we record it? To record this, we debit rent expense for $980 to reflect the increase in operating expenses. Credit cash for $980 to show the decrease in money. The narrative for this entry is paid monthly rent for August. August 6th, receiving payment from customers. Step 1. What happened? The company received $1,200 in cash from customers. This payment was for amounts owed from previous transactions recorded earlier as accounts receivable. Step 2. Which accounts are affected? Cash increases because the company is receiving money. Accounts receivable decreases because the customers no longer owe this amount. Step 3. How do we record it? To record this, we debit cash for $1,200 to show the increase in money received. credit accounts receivable for $1,200 to reflect the reduction in what's owed to the company. The narrative for this entry is received cash from customers for outstanding balances. August 7th, signing a contract. Step 1. What happened? The company signed a contract with Matthews Appliances Limited to provide future repair services as needed. No money was exchanged and no services have been performed yet. Step 2. Which accounts are affected? None. This is not a financial transaction yet. Since no money or services have changed hands, no accounts are impacted. Step 3. How do we record it? There's no entry to record for this. The narrative for this entry is no entry. Signed a contract to provide future services. August 10th, paying salaries. Step 1. What happened? The company paid $3,120 in salaries to employees. This includes $1,420 that was owed from July and $1,700 for salaries earned in August. Step 2. Which accounts are affected? Salaries payable decreases because the company is paying off the amount owed from July. Salaries expense increases because this represents the cost of August salaries. Cash decreases because the company paid this amount to employees. Step 3. How do we record it? To record this, we debit salaries payable for $1,420 to show the reduction in the liability from July. Debit salaries expense for $1,700 to reflect the current month's salary cost. Credit cash for $3,120 to reflect the payment. The narrative for this entry is paid salaries, including amounts owed for July. August 13th, receiving cash for services performed. Step 1. What happened? The company received $2,800 in cash for services they performed during August. Step 2. Which accounts are affected? Cash increases because the company is receiving money for its services. Service revenue increases because the company earned this income by completing the work. Step 3. How do we record it? To record this, we debit cash for $2,800 to reflect the increase in money received. Credit service revenue for $2,800 to record the income earned. The narrative for this entry is received cash for services performed during August. August 15th, purchasing equipment with a bank loan. Step 1. What happened? The company purchased new equipment worth $2,000. Instead of paying cash, the purchase was financed with a bank loan. Step 2. Which accounts are affected? Equipment increases because the company acquired a new asset. Bank loan payable increases because the company now owes this amount to the bank. Step 3. How do we record it? To record this, we debit equipment for $2,000 to show the acquisition of the new asset. Credit bank loan payable for $2,000 to reflect the new liability. The narrative for this entry is purchased new equipment financed with a bank loan. August 20th, paying creditors. Step 1. What happened? The company paid $2,000 to creditors for amounts owed on accounts payable. Step 2. Which accounts are affected? Accounts payable decreases because the company is paying off what it owes to creditors. Cash decreases because the company paid this amount. Step 3. How do we record it? To record this, we debit accounts payable for $2,000 to reflect the reduction in the liability. Credit cash for $2,000 to show the decrease in money. The narrative for this entry is paid creditors for outstanding amounts owed. August 22nd, purchasing supplies on account. Step 1. What happened? The company purchased $800 worth of supplies. They didn't pay cash at the time of purchase. Instead, the amount is owed to the supplier, meaning it was purchased on account. Step 2. Which accounts are affected? Supplies increases because the company is adding to its inventory of supplies. Accounts payable increases because the company now owes this amount to the supplier. Step 3. How do we record it? To record this, we debit supplies for $800 to reflect the increase in supplies. Credit accounts payable for $800 to show the increase in the amount owed. The narrative for this entry is purchase supplies on account. August 24th, paying employee salaries. Step 1. What happened? The company paid $2,900 in salaries to its employees for the current payroll period. Step 2. Which accounts are affected? Salaries expense increases because this represents the cost of paying employees for their labor. Cash decreases because the company used money to pay the employees. Step 3. How do we record it? To record this, we debit salaries expense for $2,900 to reflect the payroll cost. Credit cash for $2,900 to show the payment. The narrative for this entry is paid salaries to employees for the current payroll period. August 27, billing customers for services performed. Step 1. What happened? The company billed customers $3,760 for repair services they performed during August. The customers haven't paid yet, so this amount is recorded as accounts receivable. Step 2. Which accounts are affected? Accounts receivable increases because this is money the company expects to receive in the future from customers. Service revenue increases because the company earned income by providing these services. Step 3. How do we record it? To record this, we debit accounts receivable for $3,760 to reflect the money owed to the company. Credit service revenue for $3,760 to record the income earned. The narrative for this entry is billed customers for repair services performed during August. August 29th, receiving cash for future services. Step 1. What happened? The company received $780 in cash from a customer for services they will perform in the future. Since the work hasn't been done yet, this amount is considered unearned revenue. Step 2. Which accounts are affected? Cash increases because the company received money. Unearned revenue increases because the company has an obligation to perform the services in the future. Step 3. How do we record it? To record this, we debit cash for $780 to reflect the increase in money received. Credit unearned revenue for $780 to show the increase in the company's liability. The narrative for this entry is received cash from customers for services to be performed in the future. August 30th, paying part of a bank loan with interest. Step 1. What happened? The company paid $550 toward its bank loan. Of this amount, $500 was applied to the loan principal and $50 was for interest. Step 2. Which accounts are affected? Bank loan payable decreases because the company is paying down the principal of the loan. Interest expense increases because the company is incurring this cost as part of borrowing money. Cash decreases because the company paid this amount. Step 3. How do we record it? To record this, we debit bank loan payable for $500 to reduce the loan balance. Debit interest expense for $50 to reflect the borrowing cost. Credit cash for $550 to show the payment. The narrative for this entry is paid a portion of the bank loan including interest. August 31st, paying income taxes. Step 1. What happened? The company paid $380 in income taxes for the month. Step 2. Which accounts are affected? Income tax expense increases because this represents a cost incurred by the business. Cash decreases because the company paid this amount. Step 3. How do we record it? To record this, we debit income tax expense for $380 to reflect the tax cost. Credit cash for $380 to show the payment. The narrative for this entry is Paid income taxes for the month. Declaring and paying dividends. Step 1. What happened? The company declared and paid $400 in dividends to its shareholders. Dividends are a distribution of profits, not an expense, so they reduce retained earnings. Step 2. Which accounts are affected? Dividends declared increases because this represents a reduction in retained earnings. Cash decreases because the company paid the dividends. Step 3. How do we record it? To record this, we debit dividends declared for $400 to reflect the reduction in retained earnings. Credit cash for $400 to show the payment. The narrative for this entry is declared and paid dividends to shareholders. And that completes the month of August. Great job following along, everyone. We've handled expenses, revenues, liabilities, assets, and even shareholder distributions, all while keeping our debits and credits balanced. Next, we'll move on to posting these journal entries into the general ledger. But before we do that, let's pause. Any questions about what we've done so far? All right, class, we've done a fantastic job journalizing all the transactions for August. Now, we're ready to move on to the next step, preparing and posting to the general ledger. The general ledger is where we track each account individually. It's like a big book where each account has its own page or section. This is where we summarize all the journal entries we've made so far and organize them by account. By the end, the ledger will give us a clear view of the total balance for each account after all the August transactions. Let's break this process down step by step. Step 1. Bring forward the opening balances. The first thing we need to do is take the balances from July 31, our opening balances, and write them in the ledger for each account. These balances represent where the business stood financially before the August transactions began. Here's a reminder of our opening balances as of July 31st, 2018. Accounts payable, $2,300. Accounts receivable, $3,200. Accumulated depreciation equipment, $2,000. Accumulated depreciation vehicles, $5,000. Bank loan payable, $4,000. Cash, $8,040. Common shares, $14,000. Equipment, $10,000. Retained earnings, $17,290. Salaries payable, $1,420. Supplies, $1,030. Unearned revenue, $1,260. Vehicles, $25,000. Now, we're going to write these amounts as the opening balance for each account in the ledger. If it's an asset, liability, or equity account, the balance will carry over exactly as it was from July 31st. These balances are the starting point for the month of August. Step 2. Understand each account and its opening balance. 1. Cash. The cash account shows how much money the business has on hand or in the bank. As of July 31st, the company has $8,040 in cash. This balance is an asset, so it's written on the debit side of the cash ledger as the opening balance. 2. Accounts receivable. Accounts receivable represents the money owed to the business by customers who haven't paid yet. As of July 31st, the company has $3,200 in accounts receivable. This is also an asset account, so the opening balance goes on the debit side of the ledger. 3. Supplies. The supplies account tracks the value of office or repair supplies the business has on hand. On July 31st, the balance is $1,030. Supplies are an asset, so this opening balance is recorded on the debit side of the ledger. 4. Equipment. The equipment account represents the tools or machinery the business owns. On July 31st, the balance is $10,000. Equipment is an asset, so the opening balance is recorded on the debit side of the ledger. 5. Vehicles. Vehicles are another asset, representing the company's transportation equipment. As of July 31st, the business owns vehicles worth $25,000. This balance is an asset, so it goes on the debit side of the vehicle's ledger. 6. Accumulated depreciation, equipment and vehicles. Accumulated depreciation tracks the wear and tear on assets over time. For equipment, the accumulated depreciation is $2,000, and for vehicles, it's $5,000. These balances are contra asset accounts, so they're recorded on the credit side of their respective ledgers. 7. Accounts payable. The accounts payable account shows the money the business owes to creditors. As of July 31st, the company owes $2,300. This is a liability account, so the opening balance is recorded on the credit side of the ledger. 8. Bank loan payable. The bank loan payable account represents a long-term loan the company owes to the bank. On July 31st, the balance is $4,000. Since this is also a liability account, the opening balance goes on the credit side of the ledger. 9. Salaries payable. Salaries payable tracks the wages the company owes its employees. As of July 31st, the balance is $1,420. Salaries payable is a liability account, so the opening balance is written on the credit side of the ledger. 10. Unearned revenue. The unearned revenue account shows money received from customers in advance for services the business hasn't performed yet. As of July 31st, the balance is $1,260. Unearned revenue is a liability, so this opening balance is recorded on the credit side of the ledger. Common shares. The common shares account represents the owner's initial investment in the business. On July 31st, the balance is $14,000. This is an equity account, so the opening balance is recorded on the credit side of the ledger. 12. Retained earnings. Retained earnings represents the accumulated profits of the company that haven't been paid out as dividends. As of July 31st, the balance is $17,290. Retained earnings is an equity account, so this opening balance is recorded on the credit side of the ledger. Step 3. We're ready to post the August transactions. Now that we've carefully written down all the opening balances, we're ready for the next step, posting the August transactions into each account's ledger. As we go through each transaction, we'll record the debits and credits in their respective accounts. By the end of this process, we'll have the updated balances for every account, and those balances will help us prepare the trial balance. Take a moment to review these opening balances and let me know if you have any questions before we dive into posting the transactions. All right, class. Now that we've set up the general ledger and added the opening balances, it's time to post the August transactions. Posting is the process of transferring the journal entries we made earlier into their respective ledger accounts. This helps us track each account's running balance. Let me explain how we post each transaction step by step. 1. First, write the date of the transaction in the ledger. This helps us stay organized and shows when the transaction occurred. 2. Second, include the narrative. The narrative explains the purpose of the transaction, so anyone looking at the ledger can understand what happened. 3. Third, include the journal reference. This is the reference to the journal entry where the transaction was first recorded, for example, J1 for the first journal page. 4. Fourth, write the amount. Finally, we enter the amount in either the debit or credit column, depending on how the account was affected. Let's begin with the first transaction from August 1, and I'll show you exactly how this works. August 1st, paying for advertising. Step 1, review the journal entry. The journal entry for August 1 was debit advertising expense, $250, credit cash, $250. This tells us two accounts are affected, advertising expense and cash. We'll now post these amounts to their respective ledgers. Posting to the advertising expense ledger. Date, write the date of the transaction, August 1. 2. Narrative, add the narrative, paid for advertisement expense. This explains what happened. 3. Reference. Include the journal reference, J1, meaning this transaction came from the first page of the journal. 4. Amount. Enter the amount $250 in the debit column because expenses increase on the debit side. Posting to the cash ledger. 1. Date. Write the date of the transaction, August 1. 2. Narrative. Add the narrative. Paid for advertisement expense. This explains what